So three things before we start. When you are operating at the highest level, a lot of core principles, they are the same, irrespective of the domain you're in. It could be science, technology, business, sports, music. Excellence converges. I'm choosing investing and large cap investing in particular to talk about some of these things because that is the domain I operate in. But these concepts are as much about life in general as about investing. So that's the first thing. The second thing is these are perspectives and not prescriptions. I'm not saying this is what you should do. These are things that I see from my vantage point at this point in my life and in my career. You can agree, disagree, debate. And the third thing is the mindset that we typically have most of the time is what is the question being posed and what is the answer? I think a better mindset is what is the right question to ask here? Can I ask a better question? Can I ask a better version of this question? Can I ask a beautiful question? If you're asking the right questions, you are ahead of most people out there. So as much about life as about investing, perspectives, not prescriptions, and right questions before answers. Now, almost all the progress in the world happens when somebody challenges the consensus or the majority. Now, the irony is that the world will do everything in its power to kind of crucify this person. And that is why I often say that you should never underestimate a person that is standing alone because he has the courage of conviction on his side. At the same time, to this person, I would say you have to be prepared for a world of pain. Now, how painful can it get? So, just a few examples. Now, this is an editorial that was published in New York Times in 1903 on 9th December, I think. And they were saying that man will not fly for 1 million to 10 million years. That is the kind of effort and time frame that would be required. Wright brothers made their first sustained flight within 10 days of this. On the 9th day, they flew the aircraft at Kitty Hawk. And within 60 years, we actually landed an object on moon. In fact, when Neil Armstrong was walking on moon, he was carrying a piece of the propeller of the aircraft that Wright brothers use at Kitty Hawk. So just imagine what they inspired. And this is just one of the articles of many that were written at that point in time. What they had to go through. So they were doubted. This is actually the front page of a French magazine from the time when Charles Darwin proposed his theory of evolution. And there were multiple such caricatures and cartoons and articles ridiculing him. Now, this guy was just saying that it's not sun that revolves around the earth, it's earth that revolves around the sun. And he was not even the first person to say this. He was not the one who actually proposed this. He just supported this and agreed with the view. And the response was that he was imprisoned for the last 10 years of his life. He was under house arrest. He was not allowed to talk about his work. He was the first person in history to actually look at moons of other planets. If the 4 largest moons of Jupiter, they are called the Galilean moons. He's the father of astronomy, the father of modern physics. Einstein called him father of modern sciences. Newton was born 1 year after Galileo died. But again, what did he inspire and what he had to go through? This girl, she was saying that all I want is every girl should get a chance to go to school. That's all she was saying. And she was short, youngest recipient of the Nobel Prize. We hold these truths to be self-evident. that all men are created equal. That is what he was saying. He's assassinated, was killed. And even our mythology kind of warns us against standing out. So Prometheus, he was a titan, he was a god, he stole the fire, which is a symbol for knowledge, and gave it to mankind. And the punishment was that he'll be chained to a rock and an eagle will eat his liver. And every day that liver will grow back. So it's horrible fate. And at some point, I think Hercules, on one of his labors, frees him. So it has been really painful to stand apart from even your friends, family, the company. And a recent study, and relatively recent, I think it was 10 years ago, where the hand that you see here is basically you playing a game on a computer screen, and the other two people, they have their own computers, and the game is very simple. You just have to pass the ball amongst yourselves. What you don't know is that these two other people, they are actually not real people, but computers. And what happens is after a while, they stop passing you the ball. They are just playing amongst themselves. And at the same time, you are being monitored. A functional MRI is being done, and a scan is your brain is being scanned. And what the researchers found out is whenever they stop passing you the ball, when you start feeling excluded, the same areas in your brain light up in case of actual physical pain. So the center that is stimulated in case of social exclusion is same as the center that is stimulated in case of physical pain. And the next step, which was quite interesting, was the researchers thought, would painkillers that relieve physical pain, would they relieve this kind of social anxiety or social pain as well? And they found out that it does work. Now, this is just one study. This is not medical advice. Please don't try it. Don't start taking popping pills and all. But if it's true, it's quite neat. It makes sense that standing apart from your peers is as painful as physical pain. Now, these are extreme examples. But at the same time, Munger, for example, says that whenever you are in a fix, try to think of an extreme example, and that kind of gives you clarity about the current situation. So how are some of these things relevant to investing, and particularly large cap investing? Now, this is from the SPIVA report. SPIVA is S&P indices versus active. It is basically a scorecard of how well active funds are doing compared to passive funds. And if you just look at the purple lines, which is basically 5-year result, here 93% of the funds in the large cap space, they are underperforming their benchmark. And they are 35 odd funds. This means that there are only 2 or 3 funds that over the next 5 years probably would outperform the underlying benchmark, and the score is significantly better for mid caps and small caps. The question is why? Why is this happening? Why this pain, and why this pain is so severe in the large cap space? One thing that people say is large caps are more efficient. Everybody has the same information. It's very hard to have an edge. They can do this exercise for Indian large caps, but forget Indian large caps. Look at the largest companies in the world. So some time back, I did this, and the average move from bottom to peak in the last 1 year for these companies, it was 86%. Now, I'm pretty sure the value of these businesses, they have not changed by this much. In March 20, the largest bank in India was trading at the same market cap as the largest FMCG company, when the profits are some 3x, 4x, and the growth rates are also higher, will probably be higher for a longer time. 10 of the largest pharma companies in India, they were trading at a combined market cap that was lower than the FMCG major, where the growth rates are kind of mid-single digits, high single digits. So markets are broadly efficient, but there are times when they are spectacularly inefficient. This probably is not the reason why large caps are struggling to beat the benchmarks. The other reason, which is commonly put forth, is it's very competitive. If one AMC is making alpha, it's probably taking alpha from somebody else. Alpha is the degree to which the active fund is underperforming or outperforming the benchmark. Now, collectively, AMCs, we own only 8% of the market. Individual investors like you own 9%. There is no reason why all of us, all the AMCs, cannot have alpha. There have been instances in the past where most of the guys, even in the large cap space, they had alpha. So even this, I don't think, is the reason. So why? And this is my opinion. The reason is it has something to do with what I call is the fundamental challenge of our business. And the challenge is exactly the same as it is between me and my channel partners. 80% of the AUM in the AMC industry is broadly from distributors and banks and people who distribute our products. The challenge is same between me and the channel. The challenge is the same between me and the channel partner as it is between the channel partner and the ultimate investor. What is this challenge? Most of you know this guy, Peter Lynch. He took over the Fidelity Mutual Fund in 1977. It was just a $14 million fund at that point in time. And he retired just at the age of 46. He was there just for 13 years managing this fund. And after 13 years, his CAGR was 29%. And when he retired, this was the largest equity fund in the world. Now, this was a very different environment. During this period, even Warren Buffett, he was compounding at 26, 27%. So very different period, but phenomenal track record. And it showed in the results. Largest fund in the world. Now, most people do not know who Jeff Winnick is. Jeff Winnick took over the same Magellan fund in 92. And for 2 years between Peter Lynch and Winnick, somebody else was managing the fund. And what Winnick does when he takes over the fund is he starts changing the portfolio. So consumer stocks were something that Peter Lynch really liked. He starts selling them. He starts adding energy. He starts adding technology. Now, technology is value in 92. And he moves away from growth. And a lot of people have some quibbles about this because this is a fund that is tracked by everybody, and they're slightly uncomfortable with the changes that Winnick is making. But after 1 year, he's making some 17, 18%, and everybody kind of gives Winnick the seal of approval that he's doing something different, but it's working and it's okay, good choice. Well done. Now in 95, somewhere around here, what Winnick starts to do is he starts reducing technology. And he brings it down to 3% from 45%. He puts 11% in cash, 19% in bonds, and in multiple interviews, he's saying that bonds look better than equities. And because now he does not own technology, everybody else owns technology, and this is the NASDAQ chart, and technology keeps on rallying. The 3-year rolling return of Magellan in 96, after a long time, it starts trailing the benchmark. And there are some other issues as well. The result is that everybody who kind of supported Winnick within 3-4 years, they've all become very critical. So Barron's is running a piece saying one of the big lessons of the Winnick affair is that bonds are for losers. Knives are out for Jeff Winnick. Same New York Times, which ran an editorial that said that man will not fly for 10 million years. Jim Cramer writes an article on his blog, Forget Jeff Winnick. Forbes, Dead Man's Portfolio suggests a burnout case. Winnick resigns in 96, and one can speculate whether he resigns or is forced to resign. But over the next 6 years after he resigns, at treasuries, they deliver 78%, corporate bonds 85%. So 80% you make in bonds and equities deliver 31%. 13-year CAGR of 29% for Peter Lynch. If you trusted Finnick actually launches his own fund and does really well. But if you trust him from 88 to 2000, he closes his fund 2 months before the .com crash. You make 33%. And a world-renowned investor, well-deserved, but somebody who had to resign from his job and was probably as good or even a better strategist. Fundamental challenge of a business is the right thing to do is the tough thing to do, because evaluation and investment horizons are short. They're short across the board. And what this leads to is a lack of aligned capital. Now, most of you know that every fund manager, every style, they will go through their cycles. There'll be peaks and troughs. But what people don't realize is that 80% of the outperforming funds, and this is based on a study by Vanguard, which looked at 1,400 odd funds across 25 years, that 80% of the outperforming funds would have at least one 5-year period where they are in the bottom quartile. In fact, the alpha could be 24%. So the index could be up 24% and you are flat over 5 years. This could happen even with a good fund. And 89% of the executives, 89% of the decision makers, they do not tolerate underperformance for more than 2 years before seeking a replacement. So what this leads to is pervasive performance chasing, where people like me, the fund managers, we are chasing the best performing stocks. The channel is chasing the best performing funds, and the investor is chasing the best performing asset class. Is it helping anybody? So again, another Vanguard study, slightly older, but what you do is you randomly pick a fund in each category: large cap blend, large cap growth, large cap value, similarly for mid and small caps, and let that be for 10 years. And the other strategy is you start with quartile 1, quartile 2 funds, and after 3 years, if any fund is below average, you sell that fund and invest that amount equally in the best performing funds at that point in time. In every category, randomly picking a fund and letting it be for 10 years beats the performance chasing strategy, and this is pre-taxes. So the question is, and most of us intuitively know that performance chasing doesn't work. The question is why? Why is it so pervasive? Why is it happening all around us? And probably the reason is something called the Drunkard search or the streetlight effect, which what it means is, instead of measuring what should be measured, we measure what's available and can be measured easily. Understanding what Vinnick is trying to do, for example, why is he not holding technology? How long can this pain last? It's very, very difficult. The easiest thing to do is look at the rolling returns. And if today, for example, somebody recommends a fund that is doing really well today, and after 2-3 years, that fund is underperforming, and the client comes back to this advisor or this person, he can always say at the time that I recommended this fund, it was doing really well, and then probably the fund manager or the style, it went through a bad phase. That decision is defendable. So you are always thinking in terms of not what is right, but what can I defend? Owning technology in 95 was the easiest trade. If things went south, which they did after a few years, you could always fall back to this argument that everybody was doing it. It was new, it was revolutionary, things could have turned out very differently. But if you don't own it and it continues performing, then you are running all kinds of risks, career risks, AUM risk, the risk of looking really foolish. So every point in time, you're thinking, can I defend this decision, rather than whether that decision is right or not. What is the impact on investors? And this is my favorite investing graphic. This is from JP Morgan's Guide to Market Report. Over the last 20 years, and they publish this data almost every year, so this doesn't change from year to year. This is not specific to 2021. Every year, this looks pretty much the same. Equity markets have delivered something like 10%. An average investor over 20 years is making only 3.6%. In some years, he's not even beating inflation. even a 40-60 portfolio, where 40% is equity, 60% is debt, makes 78% higher than the average investor. Why is this happening? Because of pro-cyclical behavior. You pile in on styles, on fund managers, in funds when they are doing really well. And when they are not doing well, when they are going through the tough phases, you exit those funds. So there are a lot of instances where the fund returns are really high, but the average investor in the fund is not getting the same returns. And that is why, if let's say you've chosen a fund that is going to deliver 20% or CAGR, but you are just badly trading the fund because of your lack of confidence in the style, or because of the volatility of the fund, or your lack of confidence in the fund manager, you might end up making just 10%, 8%. And there are the multiple examples where this has happened within our company and outside as well. And you compare it to another fund which is making only 13-odd%, but because of lack of volatility or your confidence in the style or the fund manager, you stick to that fund, you actually get that 13%. Then which is better? Which is better for you? I think this is where hybrids or slightly lower volatility products, large caps, actually score much better than some of the other competing products in the market. What is the impact on fund managers? I think there's a lot of talent in the industry, but talent is blunted by the demands and the dynamics, this dynamic of the industry. And everybody is trying to manage, a lot of guys are trying to manage the enemies over next 6 months or 1 year. What happens if whatever is the equivalent of technology today, if I don't own it and it continues to rally, even though it doesn't make sense? All the focus is on valuing the stock versus valuing the business. Although you ask anybody, I mean, 9 out of 10 fund managers will tell you, I buy businesses. And we have adopted a very, very heuristic-based approach to valuations, which I think is at the core of investing. It's more interesting to talk about why a certain business is very high-quality business, or a certain management is a very high-quality management, but those are easy things. It's getting the odds right that is tough, and we are not doing it enough. Too much focus on errors of omission. So recently I came across this. Somebody said that one of the most underrated aspects of an investor is lack of FOMO. I think I completely agree. A lot of mistakes, a majority of the mistakes, happen when because of this fear of missing out. And management commentary is driving research, which in turn is driving portfolio. Whatever the management is saying is usually written verbatim in sell-side reports and taken at word by most of buy side. Too much activity, both in research and in portfolios. A lot of focus on things that are not really knowable. And what is the result of all this? This chart is basically showing the active share of each category, of the largest funds in each category: small cap, mid cap, large cap. And active share is a measure of how different your portfolio is from the benchmark. So when you're investing in an active fund, you want an outcome that is different, hopefully better than the benchmark. Now, there are 2 things that you need for this. First of all, you have to have a portfolio that is different. And second, you have to be right about the differences. And also remember that there's a cost involved. Small caps are running significantly high active shares, very high active shares, 80s, close to 90. Mid caps are running high active shares, 60, 70, 80%. Large caps are running 40-odd% kind of active shares. So when I show this data, people tell me that the universe itself is smaller, which is true. Here, 80% of the weights, they have to come from 100 stocks. But even here, there are only 150 stocks in the mid cap space. In small cap space, theoretically, infinite, but given the filters for governance, for quality of numbers, balance sheets, managements, even here, the universe is not as big. But here, in my opinion, the index itself is bad. And the way to think about small cap is how different is a certain portfolio from the average of the industry. The challenge is this. Less than 40% active share is the textbook definition of a closet indexer, where you're just replicating the index. Like, is it mathematically possible to kind of cover the 1.5%, 2% cost headwind and then deliver some alpha? Yes, mathematically it's possible. Is it very, very hard to do it with 40% active share? Yes, it is. It is extremely hard. And this is what is reflecting in the SPIVA reports, where 93% of the funds are not beating the benchmark. And this is the reason why the record is better for mid and small caps. The other thing to notice here is, are these fund managers better, or in some way they are more courageous? Maybe. But another thing here is that sometimes when you introduce a degree of difficulty in the system actually becomes more efficient. It's very easy to change positions in the large cap space. Here, sometimes it takes, at least in the small cap space, sometimes it could take you years to move out from one position to another. So this hurdle, in some sense, is actually making, or the lack of this hurdle is making the large cap space less efficient. Where today, if I have any pushback in terms of why I own something or don't own something, I can remedy that very, very easily. And that is why, as I said, the dynamics of the industry is pushing everybody to move towards the index, and that is what is reflecting here. The thing is, everybody is smart. There's a lot of talent, as I said. Why are we not deviating enough? This is from one of my funds. It's basically, what happens is, if you're running significant deviations, then in any 1 month, your deviation with respect to the benchmark, which is alpha, could be high, it could be low. But the challenge is, if you have a month like this where you take a 1.5 or 2% odd kind of a hit, then on a 1-year basis, you can move from top 5 funds to bottom 5. And this is not acceptable in this space to most people, to most investors, to most channel partners, to most FMs as well. How do you remedy this? You reduce these lines, you reduce these lines. What is the way to do it? Move closer to the index. And that is what to large extent is happening, in my opinion. Now, deviating in stochastic domains is even more difficult. So the moment Galileo, he saw the 4 moons of Jupiter, I mean, you can tell him anything. He has seen it with his own eyes. It's very hard to refute that evidence. But in probabilistic domains, a lot of bad arguments can survive for a long time. To give you an example, and this is happening across the board, across sectors. I'm just taking the example of IT sector, but I can have a similar, I can show similar things for various other sectors. So this is basically the Z-score, which is current valuation minus last 10-year average valuation divided by the standard deviation. This is a measure of how expensive the sector is. I've just written the names. These are large cap IT stocks. Now, if you look at this, it seems that they are not very expensive. Market today itself is more than 1 standard deviation away from last 10-year averages. So, I mean, they are not cheap, but at the same time, they're not very expensive. If you look at their free cash flow yields, they are, 4% odd to 7% odd. These are very healthy free cash flow yields. So I can make an argument that stocks, they don't look very expensive. In fact, on FCF, they are looking good. And then, because this is something new, generative AI, I can claim at least that this will increase efficiency, and one engineer which was doing X amount of work will be able to do 3x amount of work with the help of generative AI. That argument can be made at this point in time when everybody is struggling to kind of understand the implications. The argument sometimes is well received. Also, I can make a case that rupee can depreciate. Finally, it's a macro variable. You can give arguments on both sides, and arguments on both sides, they can seem equally intelligent or equally stupid. But if I'm presenting a bull case, I'll say that there are XYZ reasons why rupee will depreciate, and these guys benefit from rupee depreciation. They are exporters, and that is why this sector is a buy. Now, what is the other side of this argument? If you ignore the COVID period, because the COVID period distorted the multiples, and then look at what are the Z-scores, and these stocks are not, they're not as cheap. In fact, they are quite expensive, more than 1-2 standard deviation away from their 10-year averages. And this rupee depreciation argument, this is one of the largest companies. Look at their EBIT margins from 11 to 14 when rupee depreciated a lot. Their margins didn't budge. These are B2B businesses. Your clients also know that you have a margin tailwind. The contracts, they get renegotiated. This is in fact the EBIT margins of one of the largest companies, and it was close to 30 odd percent 20 years ago. And this has been coming down. The growth itself for the sector has been coming down because we were very small part of the market, some 3% odd market share 20 years ago. Today we are 13-14% of the market. Incremental market share gains are adding less and less to growth. The thing is, which of these arguments is right? And if I present both sides of the argument, people rate my understanding of the sector. They don't rate it as high when I present just one side of the argument, because then I sound more intelligent. But our reality is that there is always two sides to most of these debates, and this uncertainty is a reality. And in most cases, people miss the context. So when I share this, whenever after I upload this presentation, there'll be a lot of guys who'll point out mistakes in my way of thinking, which is welcome and appreciated. But at the same time, there'll be a lot of people who will be outraged just because they're taking something out of context. It happens all the time, particularly so on social media. Now, and most of you probably agree that high turnover is bad. This is a well accepted principle in our industry broadly. Peter Lynch had 300% turnover. Warren Buffett himself in his early days had high turnover. Some of systematic strategies have a very high turnover. So is high turnover really bad? Concentration is bad. First of all, there is a big debate in what is concentrated. Again, people miss context. So when somebody is saying concentration is bad, he's thinking about a 5-stock portfolio. The other person who's saying it is not so bad, he's probably thinking of a 30-stock portfolio. But Munger, the Daily Journal portfolio has just 4 stocks. I think the last time I checked, Berkshire itself, 25% of the market cap is in just 1 stock. Is concentration really bad? Concentration is good. A lot of people fall in this camp. Index that owns everything is beating most guys. I just showed you 93% of the funds in large caps, they are not beating the index. Peter Lynch had 1,400 stock portfolio. What is right here? Never sell quality. For the last 8-10 years, everybody has been living by this gospel. Disney, Coca-Cola. Coca-Cola is in fact one of the favorite holdings of the best investor ever. Both of these companies are underperforming over 30 years. 30 years is long enough, I would say. Value always wins, right? This is a lot of you listening to this, you're value investors, and this is our truth. Truth always prevails. Warren Buffett and Seth Klarman themselves, they have been underperforming over decades now. Can you ask, what is the right question to ask in this situation? Can you ask a good question here? Sharp ratio is important, right? So we have this physics envy, and we've picked this up from systematic trading guys who are actually running millions of strategies at times together. But for an investor who's invested in 4-5 asset classes or 4-5 funds, isn't lower worst case drawdown and high returns, aren't they important? Even if they come with lower volatility in the intervening period, which kind of reduces the Sharpe. What is right here? Market is pricing incorrectly. Today, IT is good or bad because it's trading at premium or discount to the last 5-year averages, right? That is what you read in sell-side reports. But is the last 5-year data relevant? Because it was distorted by COVID. So a lot of arguments when you're saying market is pricing the stock incorrectly, that is why it's a buy or sell. You are basing this on the assumption that market has historically priced it correctly. Mega gaps will never fall due to passive flows. This is a frequent refrain that we heard at least a year ago. And look at what happened to FANGs in 2022. So lot of debate in our industry is because people are missing the context, or they have different context in mind. And the reason why, when you present both sides of an argument, it's not, people like you less and it's not acceptable, is because we seek intellectual closure. Uncertainty is extremely stressful. So there's this another very interesting experiment where people were given this option that you will get an electrical shock right away, which will be very painful but no lasting damage. The other option is you wear a device and there's a 50% probability that you'll get this shock sometime during the next 1 week. Now, there's a 50% chance in the second option that you actually don't get this shock. But people overwhelmingly choose the first option, which is give me the shock right away. I want this to be over with. And this is what happens when you are actually working in a stochastic domain, because you will not get this intellectual closure most of the time. And then you're under pressure. And what do you do under pressure? You pick high risk options. So if your neighbor has made money buying Bitcoin, you will want to go and buy some other more exotic coins to kind of beat him. If he has made money buying a large cap, you would want to find a micro cap multi-bagger. And you don't self-regulate. And it starts kind of filtering down in your personal life as well. You will not follow the diet, stop exercising. So it escalates very, very quickly. You rush to prove that you are right. And again, a lot of examples from social media where people forget what is the point of the debate. They are just collecting facts that support their argument. The interest is no longer in what is right, but how can I prove that I'm right? Focus on immediate pleasures versus delayed rewards, the marshmallow effect, and you succumb to choice fatigue. You just want to make up your mind and move ahead. And one of the best ways to make good decisions, at least in financial markets, is procrastination. Delay. Keep your options open. And we let go of that option. Grace and poise under pressure precede the opportunity to deploy any other skill. Everything that you know, all your skill is useless if you succumb to this pressure. And at this point in time, when you're really under pressure, you will seek advice from experts or somebody who you think is an expert. And another very interesting study where you're playing some card games where there's some risk reward involved, and there's a person there who you have been told that he's an expert and he's giving you occasionally some advice. And again, a functional MRI. And what people notice is the moment the expert gives his advice, the centers in your brain that kind of calculate probabilities, risk, they kind of deactivate. So expert advice can make your brain switch off. Be very, very careful from when you hear people say that this is what is going to happen, or this is what you should do. You have to be careful in those situations. You can trust experts on facts, not on forecasts. Now, what can we do in this situation? Except investing is hard. It's very, very hard. The gap between how easy something seems and how hard it really is, it's probably the widest for investing. Of all the people watching this, including myself, there's probably one or two who has a decent probability of being significantly above average investor. It's extremely hard. Work hard. I mean, nothing good comes without it, and we have to put in the hours. We have to go through the basic texts, go through the basic theory, have a schedule of incremental learning, put in the hours. And have a sound framework built over time, nuanced with experience and tailored to your temperament. See, markets are so volatile, and as I said, we constantly work in a domain that is volatile and probabilistic and stochastic. There'll always be forces that are trying to sway you precisely at the wrong point in time. These frameworks are your anchors that keep you grounded. Know history. There's nothing new that happens in investing. All the learning in financial markets, it's cyclical. So if something is happening today, you can always find a template in time or another geography where something similar has very happened, and you can learn from those things. Accept uncertainty. Not having an opinion is actually a sign of intelligence. Sometimes the only intelligent response to a situation is, I don't know. And this is my response for 8 of the 10 things that I'm asked. I just don't know. Clarity is rare and certainty is absurd. Only on rare occasions do you get some clarity, and you have to accept it, not fight it. Accept type 2 errors. As I said, don't fear FOMO. Basically, you should be okay with missing some ideas. There are a lot of stocks, a lot of sectors that are going to do well. I'll not be able to participate in them. It's fine. I'll be fine. Always seek this confirming evidence. Keep things simple. Shun activity. And you have a big edge. That is what I keep telling people. You have a big edge if you are really happy with moderate returns. If you are really happy with 12% odd or 13% odd kind of a return, genuinely happy, then your actual returns could be higher because you will sidestep a lot of landmines. You will not make a lot of mistakes. You will not fall for the wrong themes at the wrong points in time. You'd actually do better, but you have to be genuinely happy with those moderate returns. The courage to stand out comes from conviction in your process and knowing that the downside in case you're wrong is acceptable. And here, I would urge you to study the sterling pound trade that George Soros executed. Now, we think of it as a very bold, very courageous trade that he did. But if you see from his perspective, and if you actually analyze the odds, the downside was not as high as we imagine. And that is where you get this courage to do something that seems risky to others, or that is very different from what others are doing. What else can we do? As fund managers, as investors, we have to stand for something. We have to express our conviction. We should refrain from managing enemies, and we have to communicate to get aligned capital. Now, investing outcomes are a result of a conversation, a collaboration, a partnership between me and my investors and my channel partners. We all have to work together, and there's a lot of responsibility that lies with the fund manager, but there's a lot of responsibility that lies with others as well. We have to execute this. What should investors do? I mean, you can always index. That's a good option. You will make slightly lower than index TRI. People don't realize this, which is still quite good. But if you are going the active route, then have a documented process for FM selection, and it should be independent of returns. Know why you are picking a fund manager, and the threshold for fund inclusion should be high. You should not easily give money to a new person or a new fund manager, but once you've selected them, because you've built that confidence in the approach and you think your temperament is aligned and that fund manager or that particular fund plays a role in your portfolio, then you support them over full cycles, not 1, 2, 3 years. You do not drop them over underperformance, even on a 3 or a 5 year basis. Again, perspectives, not prescriptions. So I think alpha is not just possible even in the large cap space, but it's easier than we imagine with deliberate portfolios, which is primarily my responsibility or the fund manager's responsibility, and aligned capital, which to a large extent is the responsibility of my investors and channel partners. Coming back to the first point, which is as much about life as about investing. Now, life or investing, this is not chess. I mean, this is more like poker and bridge, and you can lose a good hand, a good bet. But all we can do is keep making the good bets and hope that the gods are kind. So I discuss some of these things I share some of these stories with my son, and what I wish to tell him is that what I hope that he understands is that there'll be point in time in his life when he sees something that others don't see, when what he believes to be right is different from what others believe to be so. And in those moments, I hope he has the humility to question himself, the wisdom to explore all the reasons why he could be wrong. But if he's still convinced that he's right, then I hope he has the courage to stand by his convictions, to fight for his views. If you have a chance to create something good, better, beautiful, then you have to take that leap of faith. There's a quote by Hunter S. Thompson that I often share with him, in the hope that both of us remember it in the time of our need, and there will be such a time, because life in markets, they kind of test you, which is walk tall, kick ass, learn to speak Arabic, love music, and never forget you come from a long line of truth seekers, lovers, and warriors, explorers. Buy the ticket, take the ride. You can write to me on the transcript at dspm.com or any of my fund handles. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.